Let's jump right into Casa Academy, Chapter 16, Part 1. Today we're tackling real estate appraisal. It's a huge topic, but we're going to build the exact foundation you need to crush your licensing exam. Estimating property value is honestly one of the most fundamental skills you'll ever develop in real estate. So we're going to break down the processes, the core economic principles, and the formulas appraisers use every single day.
Here's our roadmap for this explainer. First, cost, price, and value. Second, the dust characteristics. Third, the scientific appraisal process. Fourth, 3 approaches to value. And finally, mastering appraisal formulas. Let's get our mental toolkit set up.
Section 1. Cost, price, and value. Decoding the differences.
All right, so we've got to start by unlearning a really common bad habit, treating the words cost, price, and value like they mean the exact same thing. In everyday life, sure, people mix them up constantly, but in real estate, they are completely different animals. Look at how they break down. Cost is literally just the money it takes to create or build something. And honestly, it might end up being way higher or way lower than what the property is actually worth. Then you have price. That's the actual dollar amount someone paid. They might have gotten a massive steal or they might have totally overpaid, so price doesn't necessarily equal true value either. And that brings us to value, what the property is actually worth. For appraisers, we're usually talking about market value, which is what a property should sell for under totally normal conditions.
Section 2. The dust characteristics. What creates value?
So, if value is what a property should sell for, what actually creates that value? Why is a beachfront mansion worth so much more than a tiny shack in the middle of nowhere? Well, it comes down to a brilliant little acronym, DUST. For any property to have value, all 4 of these absolutely must be present. First, demand. People actually have to want it. Second, utility. It has to be useful. Third, scarcity. It can't be infinite. Supply has to be somewhat limited. And fourth, transferability. You have to actually be able to transfer the ownership rights from one person to another. If you've got demand, utility, scarcity, and transferability, you've got value. Just remember DUST.
Building off of that, the whole appraisal game relies heavily on some core economic principles, and the principle of substitution is absolutely the beating heart of it all. Put simply, a smart buyer isn't going to pay $1 million for a house if they can buy the exact same house right next door for $800 grand. It's just basic human logic, right? Nobody pays extra when an equal substitute costs less.
Section 3. The scientific appraisal process. Step-by-step methodology.
Now let's look at the actual method an appraiser uses. By the way, before we get into the steps, your verification code is 159784. Okay, so an appraiser's job is pure objective estimation. First, they define the problem and gather their data. Then, they determine the property's highest and best use. Next up, they estimate the site value. After that, they apply the different approaches to value, which we're actually about to cover. And finally, they reconcile all those results to prep their final report. It's a very strict, logical sequence.
Section 4. 3 approaches to value. The appraiser's toolkit.
Once the data is gathered, it's time to open up the toolkit. Appraisers have 3 main ways to estimate value. The first tool is the sales comparison approach, and it leans entirely on that principle of substitution we literally just talked about. This is the one you're probably most familiar with already, because it's the most common method used for residential properties. You just look at similar homes that recently sold to figure out the value of your current property.
Now, here is absolutely the most critical rule you need to lock into your brain for the exam. Always adjust the comparable, never the subject. Let me explain. The subject property is the one we're trying to appraise. We treat its value as totally fixed. We do not touch it. The comparable properties, or comps, are the ones that recently sold. And since no 2 houses are exactly identical, we have to tweak or adjust the sale prices of the comps to force them to match our subject property.
Let's look at a real scenario. Say we're looking at file 878700, and one of our comps is superior because it has an extra bedroom. What do? We subtract the value of that extra bedroom from the comp's sale price. Think about it. It sold for more money because it had a feature our subject property doesn't have. To figure out what our house is worth, we have to strip that extra value away. So if the comp is superior, subtract from the comp. If it's inferior, like maybe it's missing a pool that our subject does have, we add to the comp. Always adjust the comp.
Moving right along, the second tool is the cost approach. This one calculates how much it would take to build the structures brand new, minus their loss in value over time. Basically, the appraiser asks, what would it cost to reproduce or replace this exact building today? Then they deduct depreciation, the general wear and tear as buildings get older.
But pay super close attention here. You always have to add the value of the land back at the end. Why? Because dirt literally never depreciates. Depreciation only applies to the improvements, the buildings, the structures, stuff like that. So the formula is simply cost to build new minus the depreciation of the building plus the pure value of the site itself.
All right, the third and final tool is the income capitalization approach. This one is tailor-made for real estate that generates steady cash flow. Think apartment buildings, office complexes, or rental properties. In these cases, a buyer is basically purchasing an income stream, so this approach calculates the value based entirely on how much money the property brings in.
To figure that out, an appraiser eventually divides the net operating income, or NOI, by a specific capitalization rate. But you've got to work your way down to that NOI first. You start at the very top with potential gross income, which is the absolute maximum revenue if every single unit was rented out. From there, you deduct vacancies and collection losses, then you subtract operating expenses and reserves. Whatever's left over, that's your net operating income. Divide that by your cap rate, and boom, you have your estimated value.
Section 5. Mastering appraisal formulas. Logic, not just math.
Look, I know the math can feel a little intimidating, but please don't let it stress you out. It's really just logical arithmetic. Once you memorize the key formulas, like the IRV and stack formulas, the real challenge isn't actually the multiplication or division. It's just figuring out which slot the numbers belong in. Your focus should just be on identifying which formula applies to the scenario and then confidently plugging the right data into the right places. Practice this a few times, and I promise it'll become second nature.
Now, as a real estate sales associate, you generally won't be doing formal appraisals. That's a highly specialized field that requires its own separate license. But you are going to use this exact same comparative logic literally every single day to prepare CMAs and BPOs for your clients. You'll be pulling comps, making mental adjustments, and pricing homes. The logic from this explainer is exactly what will make you an absolute expert at advising your future sellers.
So you've got the scientific framework and the formulas down now. But I want to leave you with a fascinating puzzle to think about. If market value relies on normal conditions, how do you appraise a property when the market is being driven by pure emotion? Think back to our definitions of cost, price, and value. When a wild bidding war breaks out and buyers throw all logic out the window, the price obviously skyrockets. But does the true value? Keep that question rolling around in your head as you study. Understanding these strict objective rules of value is exactly what's going to help you guide your clients safely through even the most chaotic real estate markets.